Hi, everyone. Thank you for joining us today. My name is Marcia Butler. I'm the webinar director here at Advice Chaser. Before we introduce our guest and get started, I need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you today's educational presentation. Attendees are muted, but we do encourage you to ask questions using the chat box. And I will need to turn that feature on just a minute. All right, that feature is on. So if you have a question or a comment, feel free to put that in the chat box. I'll be moderating those as we go along today. And if you ask a question and we're not able to get to it, go ahead and leave your contact information in the chat and we'll make sure to reach out to you after today's event. We want this experience to be as educational as possible. So again, please don't hesitate to ask for clarification or expansion of the material. And we are so happy to help you today. I'd like to introduce you to our presenter. Derek Glenser is a certified financial planner professional, husband, and father. With 20 years of education and experience with the financial service industry, he designs and executes financial plans for Gen X execs, soon to be retirees, and individuals and families looking for a more meaningful relationship with their financial advisor. Derek has the pleasure of working with individuals and families with diverse backgrounds, life experiences, goals, and financial needs, and has come to realize that success is not absolute, can be defined and measured in many ways, and is unique to the individual's specific set of circumstances. Well, Derek, I know we've been planning this for a while. I'm really excited to get into this content. Really needed for a lot of people. So we're glad to have you here, and I'm going to turn over the time to you.
Thank you, Marcia. Again, so the presentation today is 3 strategies to maximize your Social Security. My name is Derek Glenser. I'm a certified financial planner with Raymond James, and I'm grateful and happy that you were able to attend. So let's get into this. So who should you trust to advise you on your Social Security strategy? Families, friends, neighbors, funeral directors, the Social Security office. I've seen all of these played out in several different circumstances. My neighbor said I should take it right away. The funeral director recommended I file for survivor benefits. The problem with accepting that kind of advice is that they don't know anything about your specific situation. It's just general recommendations. And by accepting that advice, you could be leaving benefits on the table. And remember, the Social Security office is there to really help you process the application, not to make recommendations about your specific situation. So it's important to remember that Social Security is part of your overall retirement plan. So determining how and when to start collecting benefits is a huge decision, and it affects your retirement income for the rest of your life. So I've worked with clients in the past, and just by changing when or how they accept their benefit can increase the probability of success of their overall financial plan. So I've had scenarios where clients come in and, we put together a financial plan and we get a probability of that plan's success. And just by tweaking how they accept their benefit or how they file or when they file their benefit, we can increase the probability of their financial plan success, sometimes by as much as 4 or 5% on the plan. So people are living longer. And so the average life expectancy in the United States is now 76 years old. And that's 8 years longer than the average lifespan in 1950. And what I run into, with most people that I encounter relative to the Social Security question is, despite that information and the fact that we're living longer, most people are willing to assume that they're going to die sooner rather than later. And so by taking Social Security early, you're more or less saying, I don't expect to live a long life. And, that's really incongruent with a lot of what might be available to you. I've seen scenarios where people started taking it at 62, and yet they have a parent that's still alive and they're 90 years old. Well, the probability of you falling into that category and benefiting from delaying your benefits would have been greatly increased. And typically what we see is the break point is around 78 or 79. So, it's important to consider, what your life expectancy will be when you're getting ready to apply. So let's take a look at some claiming strategies. Strategy 1, delay claiming benefits. So the longer you wait to start collecting your Social Security benefits, the bigger the monthly amount. So workers who elect to take their benefits as early as possible at 62 may see a reduction in benefits as much as 30%. So I like to use real numbers when discussing these types of things. Let's take, for example, you were going to earn $3,000 per month when you start at 67. And that means that if you elect to take it at 62, you would get only $2,100 in benefit. So FRA, full retirement age. So that's the age at which you are eligible to receive the full amount of your Social Security benefit. If you were born after 1960, your full retirement age is 67. If you were born from 1943 to 1954, your full retirement age is 66. And if you're sandwiched in between the two, between 1954 and 1959, your retirement age, your full retirement age will be between 66 and 66 and 10 months. So keep that in mind. Here we have a scenario. Your full retirement age is 67 years old, and you elect to turn your benefits on at age 62. That's the earliest age you're eligible to collect Social Security on your benefit. And your monthly benefit amount can be reduced as much as 30%. So we'll talk a little bit more about this later in terms of why you might do this, but by and large, this is not the best strategy to adhere to. Scenario 2, your full retirement age again is 67, but you turn on your benefits at 67. So your monthly benefit is not reduced. You'll receive the full amount of your benefit. In scenario 3, your full retirement age is 67, but you're delaying turning on your benefits until age 70. And by doing so, you're going to increase your monthly benefit by 8% per year. So basically in this scenario, the government is willing to guarantee you 8% return for 3 years on your benefit. So there's no financial advisor that can guarantee a return, let alone an 8% return. But despite that, it doesn't always mean that you should delay your benefits until you turn the age of 70.
I wanted to break in here with a question before we get going because
Go right ahead, Marche.
Yeah, we had a question about inflation. Is Social Security adjusted for inflation?
Yes. So currently, under the current system, Social Security does adjust for inflation. And so they've been experiencing some of the largest increases in benefit amounts in terms of what is called a COLA or COLI, which is cost of living increase or cost of living adjustments. So, and those are predicated upon CPI. So when inflation goes up, so does the benefit amounts for people that are participating in the plan.
All right. And then we had another question in here. How are Social Security benefits calculated? How can I find that out, how much I will receive?
So one of the things that I encourage most of my clients to do, and I would have everybody do this, is to go to ssa.gov. And in about 5 minutes, you can get your account set up. And there you will find your earnings history and also what your primary insurance amount will be, whether you take it at your full retirement age at 67 for most of us, or at 62, or if you defer it until 70. So you should go to ssa.gov. It'll take you about 5 minutes and you can set up an account. So why do people turn on Social Security early? So there's really only 2 reasons that you should get your benefits in advance of your full retirement age, by and large. And the first is you just need the income. Perhaps you're not able to work any longer, or you need help with additional expenses. Then you really don't have any other choice and you elect to turn it on. The other is that you're getting declining health, and it might force you into stopping working, or you get diagnosed with a terminal illness, or you've got real significant longevity concerns on, within your family. Those could be a couple of reasons that you might consider taking Social Security before your full retirement age. There is a third, which, frankly, part of the reason why you're participating in this webinar, I'm assuming, is to avoid that, which is being uneducated about your other options. So we're going to discuss some of those other options that are available and hopefully, give you the proper tools so that you can, make the right decision. So in terms of an additional strategy, need to take advantage of the spousal benefits. So you are eligible to claim on your spouse's ex-spouse or deceased spouse record. And that has changed significantly since legislation was passed in 2015, but you can still make those claims. And some married couples find it beneficial to use the spouse with the lower earnings, and they record and file on their Social Security first on their record, and then they delay collecting the higher earners benefits for as long as possible. And that can be an effective strategy, particularly if you've got disparity between, one spouse. Perhaps the wife makes more than the husband, or vice versa. It doesn't really matter, but there's disparity between incomes and benefits. Sometimes it makes sense. Hey, let's defer the higher earning spouses for as long as we possibly can, but we need some additional money right now. So let's take the lower persons and get it started, because it won't affect us, in the long term, if we're at least maximizing higher income spouse. So here are some stipulations. First, you must be eligible to apply for Social Security. So for you to apply, you have to be at least 62. And so you have to acknowledge that your benefit may be reduced. So if you are married, your spouse must have already filed for Social Security if you're going to be filing on their benefit. And if you are divorced, you've had to have been married for at least 10 years, and you may not be remarried. So your ex-spouse has to be eligible for Social Security for you to file on their benefit. I saw some questions.
Yeah, and some questions here. So you can actually file for both at once, or one at a time? Explain that strategy again.
So no, what you would do is in the previous scenario, what you're looking to do is, if you've got a lower income spouse, that person, and if they are eligible to file, that means they have to be at least 62 or above. They file on their own benefit. And then what you do in terms of a strategy is you defer the higher income spouse until at least full retirement age, but ideally until 70. And this is just for people that maybe need some supplemental income and, you know, are looking to, you know, maximize the benefits on the other spouse's, earnings record.
We've got another question in here. I'm going to kind of hold it to the end. So
Okay,
let's go ahead and keep going, and then we'll
perfect.
get some more questions in here as we go along.
Great. So widows and widowers, this is a unique scenario. You can collect 100% of the higher earners benefits. I want to caution some people. I've seen scenarios play out where you're entitled to survivor benefits, and that's as early as 60 years old. The thing about that you need to be careful about here is if you do apply for those benefits, that means that the amount that you're going to get is going to be reduced if the person who died was not at their full retirement age. So that's something to consider. You know, looking at these situations, taking a survivor benefit seems like an easy thing to do, but maybe what's better is to actually file on your own benefit, allow the survivor benefit to continue to grow until the full retirement age, and then turn it over to the survivor benefit. So I've had certain situations where that has occurred in my practice with clients.
Interesting. We did get another couple of questions in here
Go right
that
ahead.
are fit in here. If you're unmarried, can you collect on it? So if you're unmarried, I guess, and divorced, can you collect on an ex-spouse's Social Security at age 62?
They have
And
to
then
be,
collect on your
yeah,
own benefit
there's-
later.
no. Well, I take that back. Yes, you are. First of all, you have to meet two criteria. The first criteria is, number one, they have to be eligible for their benefit. So your ex-spouse has to be eligible for a benefit at that particular point in time. So you might be 62. If they're 55, you can't file on theirs. Okay, so that's the first thing. Second, you have to have been married for at least 10 years. Okay, so if those first two things occur, then you can file on theirs. And at the end, they're going to end up giving you, and then you can defer your own until, you know, you reach full retirement age.
All right. So those are the stipulations on that. Thank you. I know we're getting more questions in, and we will have a question and answer portion at the end here. So let's go ahead and continue going. This leads into another question we got. So let's talk about this third strategy.
Yeah, so this is one that's really important, and it's to avoid filing for Social Security benefits during high income years. So once you reach your full retirement, which in most cases now, because people are aging up, we're getting into, you know, 67, your Social Security benefit is taxed based upon your income, and up to 85% of the benefit can be taxable, but you won't lose benefits. However, if you have not reached your full retirement age, that means for most of us, if we're below 67 and you're still earning income, and that income exceeds a yearly limit, your benefits will actually be reduced. So in 2023, the income limit is $21,240 per individual. So if you earn $2 of income, every $2 of income above that amount, you're going to lose $1 in benefits. Again, I like to use a real life example. Let's say you earn $10,000 above the $21,000, $240 that you're allowed to earn. You're going to lose $5,000 in benefits. So it's significant. It really doesn't make a whole lot of sense to begin filing if you're going to be earning above that limit. Now, it's by the individual. So let's say your spouse is still working and they make $100,000. That's okay. If you filed and you're below $21,240, you won't lose any benefits. Okay, so it's just based upon the individual. It's not looked at from a couple standpoint at all. So that's a nice feature. But you don't want to go above the 21,000 $240 threshold if you're getting benefits, because you're literally going to be giving back money to the government. You're not going to get your full benefit. And it means that you've also applied and gotten it early. So you're doing it before your full retirement age. Once you hit full retirement age, you can earn as much as you want. So you can earn well above $21,240 at 67 or whatever your full retirement age is. So that's something that you really need to pay attention to.
All right. Well, we're going to wrap up with some final thoughts, and then we're going to take a bunch of questions after this.
All right, that's fine. So I think really from my perspective, I mean, what you need to do is you really need to weigh your options and consult a financial professional. And when you choose to collect Social Security benefits, depends on your financial circumstances and other factors like your family dynamics, your health, longevity, and what you've saved for retirement as well. Because there's so many nuances to claiming, and because guidelines change constantly, it's important to discuss these strategies with your financial advisor and consider them within the context of your overall retirement plan. So happy to answer some additional questions. And thank you for your time.
All right. Well, let's go ahead and get into these. I imagine the questions are just going to be as meaty as some of this strategies that we've discussed. So can you elect to take partial Social Security, or do you have to take the entire amount?
No, you cannot elect to take a portion of Social Security. Once you apply, you're basically committed to that strategy. And then the other aspect is you only have 12 months if you elect to get in, and let's say you do it at before your full retirement. So you started at 62. That means you're going to be discounted for the rest of your life. Okay. And you do have a 12-month grace period where you could apply for something. And I've had scenarios where, I've had clients who, they got recommendation from their neighbor. They really felt like, I need to get all my money. I need to make sure that I get everything back that I can possibly do. She was 62, or they've been 62 years old, and they've got, a father that's still alive at 90. Well, the break point is around 78, 79 years old. So you definitely want to, consider those things, but you can't get a portion of it other than what your primary insurance amount is, and predicated upon, when you apply, it'll be discounted if you do it in advance of your full retirement age.
And you mentioned the break even or breakdown.
Yeah.
Can you explain what that is?
Yeah, sure. So typically what we see is people, if you do begin getting your benefit at 62, you're going to get paid for 5 years before your full retirement age. So somebody that takes it at 62 versus somebody that's taking it at 67, they're going to have the benefit of getting paid for 5 years. And somebody that defers to 67, typically what we see is that increased amount of the benefit that you get by waiting will absorb that 5 years of payment by about the time you turn 78 or 79. So when I talk about financial plans with clients and we sit down and we do a Social Security analysis, we will look at different applying scenarios and how much your aggregate benefit will be based upon, whatever life expectancy we assume for our client. So if it's at 85, we make a determination, hey, if we applied at 62, how much in aggregate did I get in terms of benefits? Oh, I got 500,000 if I applied at 62. Then at 67, oh, I got 600,000. So what we can actually see quantitatively how much more benefit you get based upon, your life expectancy or projected life expectancy. And in between there is going to be a break point, a point at which for each day you live going forward, you're in the money relative to the program compared to taking your benefit as early as possible. And that's what I'm referring to in terms of break point.
All right. Thank you so much. Okay. I had a couple of points of clarification. So
Sure.
the $21,240 that that you had mentioned on this scenario. Let me pop up that slide again. Is that a yearly amount or a monthly amount?
That is a yearly amount.
Okay. All right. Thank you. And then someone had asked if they had popped in a little later, I'm assuming, if there's a recording of this. Yes, we are recording, and we will be sending out a link to that email. If you registered for this event, you will automatically get that in a day or so. All right, here's another question. Can you create an account on ssa.gov before turning 62 to find out how much you could get?
Excuse me, can you repeat the question? I'm sorry.
Yeah, so if you're not 62, can you still create an ssa.gov account on the Social Security Administration?
Absolutely. Yeah. You can be, as long as you've got a work, or if you've got a social security number and you've got a work history, then it's basically there waiting for you to do it. They used to send out every year, we would get a report. And what happened was it was very costly for the Social Security Administration to send out those reports, and they will do it periodically now, but not nearly as much as they used to. It used to be a yearly event. So now your entire report is there available to you. It's waiting for you. You just have to sign up.
I will tell you personally that, a couple years ago when I started with Advice Chaser, I found out that you could do that, and I signed up for my Social Security Administration account, and I can log in and see my monthly, kind of the projected benefits like you'd said. And so, yes, it is available. All right, here's a really great question. Can you start collecting a benefit at, say, 65 and then stop it a few months afterwards, or after a year? I'm not sure if that's exactly what they meant, but can you talk about starting and then stopping it and what you have to do in order to do that?
So it's not the easiest thing to do. You can start your benefit and rescind it, basically, or suspend it. You'll have to pay back the money, whatever they gave you. So basically what you're doing is you're electing to change your election. So let's say, for example, you're a 65-year-old and you think you're going to retire, and you decide to turn on your Social Security benefits, and you apply to file. You file and you begin receiving benefits. And then 6 months later, you're like, you know what? I think I'm going to go back to work. I want to suspend my benefits. You've got to do a couple of things. First of all, you have to submit the paperwork through the Social Security Administration to say, I've elected to go back and, continue to defer my benefits. You have to pay back the entire amount that they've given you. And you have to do that all within the first 12 months. Again, this is a change to the program. It used to be you could actually take all of the benefits, maybe started at 62, and people did this. They literally would start taking the benefit at 62, collect all the money, invest it, then pay it back, and then, act as if they've deferred it. But they've changed that now within the system. You're only allowed to do this one time, and you can do it up to 12 months. So after you make your decision, you have 12 months basically to change your mind. And remember, you're going to have to pay it back.
All right, so we did get another question. And so if you start your benefit, say at age 62 or 63, and then you stop it, let's say you get a full-time job, you would have to go through that process to pay it back, file all the paperwork, and that has to be within the first 12 months of,
that is correct,
of signing up. Otherwise, that's just there's no going back. Is that correct?
There is no going back. And I did see somebody pop up as their interest or not. There is no interest, but you have to pay back everything that they provided you.
All right.
So, and people have to have, that money on hand in order to do it.
Yeah.
So, my recommendation is, everybody's circumstance is certainly different, but applying before your full retirement age really has to be calculated out. and if you're earning income, or if you think you're going to go back to work, it's a pretty low threshold to earn $21,240 in a given year. So you got to be careful to keep it under, because for every $10,000 after, you're going to lose $5,000 in benefits.
All right. Here's a really great question. We got this a couple times. Is there a maximum to the amount of Social Security you can receive?
Yeah, so currently there is an earnings limit where, Social Security is actually considered to be a regressive tax because everybody pays up to a certain portion. Everybody's going to pay that amount. And it goes up to about $160,000. So you are paying 6.2% of your income into that, up to that amount, and it's capped there. So every dollar that you earn after $160,000 is not taxed at Social Security, and your employer pays the same amount up until that amount. And then based upon, so for example, if you were a person who over a specific period of time earned the highest level and paid into it at the highest amount, you will get the highest benefit. I think it's around $4,500 is the maximum benefit that's being paid out right now that's on a monthly basis. So in order to achieve that, you would have had to have maxed out, at least 10 quarters, or however they evaluate it based upon a yearly basis, at the maximum threshold of paying into Social Security.
All right. And then,
but it is capped. It's both
capped
in terms of where it's taxed, and the primary insurance amount is not, uncapped. You can't, because obviously you're not paying in more than anybody else is.
All right. And will the government pay the entire estimated Social Security benefit in bulk, or is that or is it a monthly payment?
No, there's no such thing as bulk. I mean, they pay on a monthly basis, period. In terms of, there is no, bulk payment, because they don't know when you're going to die. So it's predicated upon you living. And that's one of the reasons why I encourage people to really pay attention to, what their family history is, what their personal health is, and bet on themselves to live, as opposed to, taking it early and more or less kind of, suggesting that they're not going to live as long. But there is no payment method other than, I will say that if you apply, and the Social Security Administration right now is really behind, there's been a lot of cuts, and, some people are worried about, what's my benefit going to be like now. Changes to benefits could absolutely occur in the future, and we don't know what the government is going to do. Can't operate that way. But if you apply, and let's say you applied in February and you were eligible, and you don't get your first benefits check until May, it'll be based upon when you file. So, and if you were eligible at that time, so they will retro that amount back to when you file. But no, you won't get anything in terms of a lump sum, because frankly, they don't know how long you're going to live. And you're not entitled to a specific amount. It's like so it's predicated upon, your earnings history is the primary issue.
All right. Here's another question. So this person's asking about a marriage to a first spouse. They were married for over 10 years. They had a second marriage, but that marriage ended before the 10 years to that spouse. They'd
only be eligible. They'd only be eligible for either their own benefit or the benefit of their first ex-spouse.
And is it correct that it's half of the higher
so what it would be is they're going to give
yeah.
they're going to give you the depending on where you're at in terms of your age. So you used to be able to file and suspend your own, and now they don't allow that. So you're going to get the larger of the two, either 50% of the ex-spouse or 100% of your own.
Yeah, that goes into another question about, if there were different rules for people who were born before 1954.
It's actually 1950 though.
Oh, okay. All right.
Yeah, that's where the change is. Social Security made a significant change back in 2015 when they changed some of the ways in which spouses could file for benefits. Previously, you could file and suspend your application and defer it, and then take 50% of your spouse's benefit and allow yours to accrue and get the benefits of that. And that applies to anybody that's still in place for anybody that was born prior to 1954. But everybody born after 1954, that is no longer an option, and that is not available to you. So you're going to get one or the other. You're going to either get yours. The only circumstance where it comes up is with a survivor benefit. So where you're a widow, where you can actually kind of defer some things and then, file on your own and defer your survivor benefit. That is an option that's still out there, but it won't go past the full retirement age. So you won't get the 8% kickers. You'll get it at your full retirement age.
Very interesting. And, we were talking about this earlier before the webinar, Derek, how complicated this can be and how it's not just a one and done kind of solution. It has to be really evaluated.
Yeah, I would recommend that if you're working with a financial advisor, they perform a Social Security analysis so you can see all of your options and play with your options. And this affects married couples probably a little more than the individual, just because there's multiple scenarios that can play out. When you're an individual, it's a little bit more straightforward, right? Because you're not manipulating any kind of combination of things. It's, am I going to take it early? Am I going to take it at my full retirement? Am I going to take it at 70? When you've got a spousal type situation, then you can say, well, let's turn his on now and defer mine. There's multiple scenarios that can occur there. So it's a little bit different, but they should all be looked at. And it's also good to be able to see it from a quantitative standpoint. I mean, people need to realize that if you saw your benefit in terms of a lump sum, you would probably be more, it would be more impactful to you, right? Because if you're going to be earning, I don't know, 30 or 40 or $50,000 a year off Social Security, there's a lump sum behind that actually pays for that. So if that was within your financial plan, it would look significantly different. It's one of our only sources of guaranteed income for most of us now, that defined benefit plans, pensions have gone away by and large.
All right. I have a lot more questions. I'll try to pick and choose the ones that we haven't already covered here. So can you talk a little bit about Medicare and its relationship to Social Security? There was some confusion there.
So basically you're required to, its relationship to Social Security is just, I will say, is just one of the ways in which that you're actually billed. So when you start taking your Social Security benefit, they'll deduct your Medicare payments through that. Okay, up until that point, you'll write checks, but you do have to apply for Medicare. It's a separate application. It's not interrelated in that way. And that occurs when you're turning 65. Your enrollment period actually is a 7-month period. It's 3 months before your 65th birthday, the month of your 65th birthday, and then 3 months after your 65th birthday. If you are 65, or you're 64 and you're getting ready to turn 65, you need to be aware you need to apply for Medicare even if you don't use it. Like, for example, if you're still married, or if you're still on healthcare benefits through an employer, you still need to apply at 65. You have 3 months before, the month of, and then 3 months after. But they're not really related, other than the fact that they're going to deduct your Medicare payments from your Social Security benefits check.
And I will say that we have done several Medicare webinars, and so you can go to advicechaser.com and type in on our webinar search tool Medicare, and you can get some more information about that program. It is another one where it is complicated, and it does need some probably some study to figure out exactly what would be right for you. Also a place where a financial advisor or someone who specializes in that can help. All right. So ours is Social Security taxed?
Yes, it can be. It depends on your income beyond Social Security. So some people, if they're really just living on Social Security, there's a low likelihood that you're actually going to be taxed on Social Security. But if you're a higher income person, so let's say you're taking a lot of distributions from your IRAs, or you have a pension, you have additional sources of income, up to 85% of your benefit can be taxed. Only 15% of your benefit is not going to be taxed. Up to 85% of your benefit will be taxed. And it's income dependent. It depends on how much you make.
And is this counted as regular income?
Pardon me?
Is it taxed as ordinary income?
Yes, it will be taxed as ordinary income. And again, this is where they get into and that's why when we had the one question about what's included in income, it's going to be wages and things of that nature. But Social Security looks at some things that don't necessarily fall into that category, like municipal interest off bonds and things of that nature. So it's not as cut and dry. But the point is that if you're earning income, whether it's through RMDs or other sources of income, up to 85% of it can be taxed. Only 15% of your benefit is non-taxable.
All right, we did have a question in here about disability, and that's beyond the scope of this webinar, so I will refer you to our website. We do have some webinars about disability on there.
It's a whole nother animal.
Yeah, it really is. If a spouse has turned 62 and is not working, and we can't say anything for your specific situation, but if they start taking Social Security, does that make sense? Whereas the other spouse is still working and hasn't taken Social Security yet? How do you determine as far as spouses go?
Yeah, so, well, in that circumstance, in order to file on the other spouse has to be eligible for a benefit. And you have to remember that anytime you're taking at 62, you're going to be doing it at a discount. So whether it's on your record or on the record of your spouse, it's going to be discounted. So the only reasons why you do that is you have no other choice. You need income, your health is poor, and so you're like, hey, I'm electing to take this benefit. But you've got to do it with your eyes wide open, which is because once you apply, it doesn't matter what your spouse does. Your benefit is now locked in. They're not changing it based upon your spouse continuing to work and continuing to earn credits. So if you went off of it, it's going to be based upon what their benefit was on the day that you did it.
All right. And then we had another question about surviving spouses. And I think we covered this already, but if you can just reiterate that.
Yeah, so a surviving spouse can get survivor's benefits at the age of 60. I want to explain when it would be a good idea to do that, when maybe it's not the best idea to do that. Let's say the wife is the primary breadwinner and does very well and has a great record on her own. And her spouse dies. And she's eligible for Social Security, survivor benefits. Now, if she's doing that well, then she probably wouldn't take the benefits, right? But let's just assume that she takes the benefits and she doesn't have to worry about her own record being damaged. Then that's a scenario where you could see where maybe that would work. But where it doesn't work is, I've seen this case happen in my own practice where the primary breadwinner dies. The spouse, who's maybe close to 62, starts taking survivor's benefits. But that means that survivor's benefit was predicated upon a discount because they took it before the full retirement age. So a survivor benefit will grow for you up until the full retirement age of the person that is deceased. So you have to be very careful. So I've had scenarios where I've had clients refund the money and then file on their own, which was a lower amount, and then defer the survivor benefit, which that's one of the tools that's still available to you. But it just depends on what your earnings history is versus the deceased person's earnings history, what you're currently making. There's a lot of factors that go into that. So it's not a one size fits all, but there are survivor's benefits as early as 60.
All
It
right.
doesn't mean you should take them.
Yeah, it would be an individual situation that has to
Yep.
be evaluated. Okay, another question here. What if you were a stay-at-home parent and you don't have enough work credits on your own history and you're divorced?
So the question really is whether or not, you were married 10 years. If you weren't married 10 years, if you're married 10 years, then you're going to be covered under Social Security. You're going to need to keep your divorce papers, your marriage license, those types of things. So that way, when you apply, you can apply. It does not affect your ex-spouse's filing in any way, shape, or form. It won't affect them at all. It doesn't affect what they're going to get. Don't let anybody tell you anything differently relative to that. That's something for divorcees, whether you're a man or a woman. You filing on somebody else's record affects them not at all. My parents are divorced. My mom had filed under my dad's record. They were married for over 10 years. So that is, part of the process. But you have to have been married for at least 10 years. And if you weren't, then yes, then you don't have a record to file on. And at some particular point in time, if you want to get Social Security benefits, you're going to have to establish a work history and an earnings history.
All right. And then we had a couple of questions here about if, again, I will reiterate, we will be sending a link to the replay of this event in about a day or so. So look to your email for that. Well, I'm going to ask one more question, then we're going to wrap things up. If you work a full-time job and retire at 70 and you file for Social Security at 70, so I'm assuming you're doing that delayed retirement, or I'm sorry, delayed benefits. And so you start a business after age 70, how will that affect your Social Security being taxed? Can you go over that again?
Not at all. It won't affect it. It won't affect your benefit. I mean, it'll affect your taxes based upon how much money you earn. So if you're earning a lot of money in your new business, that's fine. The thing is really you've got two separate scenarios here. You have the benefit versus a taxation issue. Taxation is always going to be from whether you're 62 or 67 or 70, it's going to be based upon how much earnings you have. But giving back benefits because you earn too much can only occur before you turn 67. After 67, you can earn as much as you want and get your benefit. And that's really the big thing that we're talking about here. There's a penalty for taking it early if you are earning money. You can't just take the money and earn indiscriminately. They will pull back on your benefits. There's a difference there. So at 70, it doesn't matter. You deferred, you got the extra money, that's great. Then what will happen is, your earnings of your new business or whatever your job is that you're doing at, at that particular point in time will dictate how much of your Social Security benefit is going to be taxed, and also your tax rate. So our tax rates are, predicated upon their marginal tax rates, and they're done in tranches. So your last dollar is going to be taxed at your highest rate earned. So, and that's going to be variable depending on how much you make.
Well, with that, we are going to have to close out our question and answer portion. I will say that we probably could go on for about 2 more hours just doing questions and answers. There's always a lot of questions about Social Security, and that's why we're here, is to refer you to people that have these answers. We've also got a large library of webinars that you're welcome to look at as well. So I want to thank Derek for being here and for providing such good information.
Thank you for having me.
Yeah, absolutely. And I want to remind people again that you will be getting a link to the replay of this event, and you're welcome to share that replay with friends and family. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. So to find out more, go to advicechaser.com and click on the link to find an advisor. We're getting some thank yous in the chat. We thank you too for being here. And we will see you hopefully at another webinar very soon. Goodbye, everyone.
Thank you.